Welcome to Market Watch Deep Dive, where we peel back the layers of the global economy to reveal the forces shaping our financial future. Tonight, we confront a paradigm shift, one where financial instruments, once mere tools of commerce, have been refashioned into potent weapons of statecraft. The era of unfettered economic interdependence is giving way to a new reality, where access to capital, markets, and even payment systems can be leveraged as instruments of national power. We are witnessing the rise of weaponized finance, a complex and often devastating strategy that is redrawing geopolitical maps and forcing a profound reckoning for corporations and consumers alike. The catalyst and current state.
For decades, the global financial system was designed for maximum efficiency and integration. Supply chains optimized for cost, capital flowing freely across borders, and a reliance on a universally accepted currency, the US dollar. However, the geopolitical landscape has hardened considerably, revealing the vulnerabilities inherent in such extensive interconnectedness. We've tracked a significant uptick in the application of economic sanctions, moving beyond targeted individuals to entire sectors and even national economies. Data from the U.S. Treasury's Office of Foreign Assets Control, or OFAC, shows a staggering 900% increase in active sanctions programs since the early 2000s. Transforming them from a niche policy tool into a primary foreign policy lever.
The freezing of Russian central bank assets, approximately $300 billion following the invasion of Ukraine, was an unprecedented move, shattering previous assumptions about the sanctity of sovereign reserves. Major financial institutions like JP Chase and Citibank had to immediately untangle complex relationships, suspending services and blocking transactions to comply with the swift and severe sanctions regime. Companies like McDonald's, Starbucks, and even energy giants such as Shell and BP exited the Russian market, often incurring significant write-downs and strategic losses, signaling a willingness to prioritize geopolitical alignment over immediate profit. This demonstrated that corporate boards now face a new calculus, where geopolitical risk is not merely an external factor, but a central determinant of market access and operational viability.
For the average person, the immediate impact was often a sudden rupture in everyday life, not just in sanctioned nations, but globally. Consumers in Russia suddenly found their international credit cards useless, their access to global streaming services cut, and their ability to purchase once common imported goods vanished from shelves. Conversely, Western consumers faced rising energy prices, exacerbated by the global reallocation of oil and gas supplies and the removal of Russian commodities from traditional markets. The availability of certain critical raw materials, disrupted by sanctions and counter-sanctions, trickled down to affect everything from smartphone components to fertilizer costs, pushing up prices at the grocery store.
Underlying structural drivers. This strategic pivot towards economic statecraft isn't merely a response to recent conflicts, it's rooted in deeper structural shifts. The limitations of conventional military intervention, coupled with the unparalleled reach of the global financial system, have made economic levers increasingly attractive. But what are the foundational elements driving this pervasive transformation?
One key driver is the sheer financial interconnectedness of the modern world, which paradoxically offers both immense leverage and profound fragility. Global trade as a percentage of GDP has nearly doubled since the 1970s, making entire economies susceptible to external financial pressures. The rise of digital finance and cross-border electronic payments means that financial flows can be monitored, manipulated, or frozen with unprecedented speed and precision, far more effectively than physical blockades. Moreover, the proliferation of data analytics allows for highly targeted sanctions, minimizing collateral damage while maximizing pressure on specific entities or individuals.
Central banks around the world are rethinking their reserve management strategies, moving away from an almost exclusive reliance on a single currency, predominantly the US dollar. We see increasing diversification into gold, other major currencies, and even commodity reserves, driven by the perceived risk of future asset freezes. Furthermore, nations are actively exploring and developing alternative cross-border payment systems, such as China's CIPS as a potential rival to the SWIFT network, or the EU's Instex mechanism, though its efficacy remains limited. Corporate boards are now mandating comprehensive geopolitical risk assessments, scrutinizing supply chains not just for efficiency, but for vulnerabilities to potential sanction regimes or nationalization threats. This means significant investments in mapping the origins of raw materials, identifying dual-use technologies, and diversifying manufacturing bases across multiple politically aligned jurisdictions.
The long-term implications for the consumer are quite profound, contributing to a fragmentation of the global marketplace. People in different regions are increasingly experiencing divergent product availability and pricing, often due to nationalistic procurement policies or retaliatory tariffs. For example, consumers in countries facing digital restrictions might find popular apps or software services unavailable, or their functionality severely limited, creating a splinternet experience. This trend extends even to critical medical supplies or specialized industrial components, which become harder to source or significantly more expensive outside of politically favored trade blocs.
Institutional and consumer divergence. The unfolding narrative reveals a striking divergence. States wield increasingly potent economic tools, corporations scramble to adapt, and individual consumers often bear the brunt of these high-stakes maneuvers. This gap between macro-level geopolitical strategy and micro-level lived experience is widening, creating distinct economic realities.
Multinational corporations are no longer simply optimizing for cost. They are strategically de-risking their global operations, often at a premium. This involves nearshoring or friendshoring critical production, pulling manufacturing out of potentially adversarial nations and into politically aligned countries, even if labor and operational costs are higher. For instance, companies in the semiconductor industry are investing billions in new fabrication plants in the US and Europe, despite higher production costs, to secure supply chains from geopolitical disruptions. We also observe a trend of increased investment in dual-use technologies, innovations that have both civilian and military applications, reflecting a broader integration of economic and security considerations in corporate strategy. This repositioning often results in significant restructuring costs and a shift in global investment flows, favoring politically stable, albeit potentially less cost-effective regions.
The economic costs of compliance for businesses navigating this weaponized landscape are immense, often eroding profit margins and deterring foreign direct investment in certain regions. We've seen a noticeable slowdown in cross-border M&A activity involving entities in geopolitically contested areas, as regulatory hurdles and reputational risks become prohibitive. Furthermore, the increasing use of secondary sanctions, which target third-party entities that transact with sanctioned countries, creates a vast chilling effect, forcing banks and businesses into a complex web of risk calculations. Analysis by the Peterson Institute for International Economics suggests that cumulative GDP losses for sanctioned countries can range from 1% to 2% annually, while the global cost of sanctions compliance for multinational firms now exceeds hundreds of billions of dollars.
The most immediate and painful divergence for consumers is often the direct hit to their purchasing power and the constriction of choices. Higher compliance costs for corporations translate into higher prices for goods and services as businesses pass these expenses on to the end user. Furthermore, the shift to friendshored or localized production, while strategically sound for nations, often means the loss of economies of scale, leading to more expensive products across the board. For individuals, the erosion of international financial mobility is palpable. Cross-border remittances become more complex and costly. Access to international banking services might be restricted, and even the simple act of planning international travel can be fraught with payment system uncertainties. This creates a feeling of being caught in the crossfire, with the geopolitical decisions of states directly impacting their daily budgets and freedoms.
Forward macro projections. As we look ahead, the trajectory of weaponized finance suggests a global economy increasingly fractured along geopolitical lines. The notion of a single, interconnected global marketplace may well be receding, replaced by a more complex, segmented landscape. What does this mean for the future of global commerce and the very architecture of international relations?
We are likely heading towards a more pronounced bifurcation of global economic systems, creating distinct spheres of influence and trade. Scenario planning models suggest a growing probability of digital iron curtains, where national digital ecosystems and data flows are increasingly siloed, impacting everything from cloud services to cross-border e-commerce. The long-term effectiveness of sanctions remains a complex debate, with some studies indicating their limited ability to force significant policy changes in determined regimes, while others point to their cumulative debilitating effects. The proliferation of alternative currencies, particularly central bank digital currencies, could further decentralize global finance, complicating monitoring and enforcement mechanisms while also offering new avenues for bypassing traditional financial gatekeepers.
The implications for international law and global governance are profound, potentially weakening the very institutions built on the premise of universal economic principles. We may see a rise in international legal disputes surrounding the legality and proportionality of sweeping financial sanctions, challenging established norms and potentially creating new precedents. The role of multilateral organizations like the WTO and the IMF could diminish if global trade and finance increasingly flow through geopolitically aligned blocs rather than universally accepted frameworks. Corporations will continue to invest heavily in geopolitical intelligence and adaptive strategies, effectively becoming mini-diplomatic entities themselves, navigating a patchwork of regulations and national interests. The quest for supply chain resilience will drive further regionalization, with companies prioritizing security of supply over lowest cost, leading to potentially higher inflation and less efficient global resource allocation.
For the global consumer, the future may involve a continued trade-off between choice and security, convenience and national alignment. We could see the emergence of patriotic purchasing, where consumers are implicitly or explicitly encouraged to favor domestically produced goods or services from politically allied nations. The ease of international travel, education, and even cultural exchange could be hampered by diverging payment systems and more stringent visa or financial controls. Ultimately, the average person may find themselves living in an economy more shaped by the decisions of state security councils and diplomatic chanceries than by the traditional forces of supply and demand.
The weaponization of finance is not merely an academic concept. It's a dynamic force actively reshaping our world, from sovereign balance sheets to individual bank accounts. It demands vigilance, adaptation, and a deep understanding of its profound implications for the future of global prosperity and stability. But thank you for joining us on Market Watch Deep Dive.